Hello, everyone. I'm your host, Cam Webster, and welcome to The Art of Boring, the podcast where we dive deeper into Mawer's investment philosophy and thinking in order to help you, our listeners, become more informed investors. Ultimately, we hope to connect you with the people at Mawer who find excitement in delivering on Be Boring, Make Money. On this episode, we speak with Christian Deckart, lead portfolio manager of the Mawer Global Small Cap Strategy. We talk about a few of the holdings in the portfolio to demonstrate the small cap life cycle, how M&A situations present a double-edged sword, and how we continue to turn over new stones. Thanks for listening.
This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Any views expressed in this podcast are based upon the information available at the time and are subject to change.
Welcome to the podcast. Today we have Christian Deckart. He's our lead portfolio manager on Global Small Cap. So welcome to the podcast.
Thank you, Cam.
Once again, we've had you on before. Why don't we start with some of the key characteristics of a global small cap business, Christian? What is it? Is it basically a startup with a listing? So a public listing is just a startup, or is it just a number, like a market cap size? So let's start there and proceed into some of the details.
Yeah, pleasure. So first part of the answer, it's not just a number to us. There's probably two elements that we would look at most. The first one is what I would call the position of the company in the small cap life cycle. So what do we mean by that? Company starts small and usually unknown to the broad public. It will be small, it will have little analyst coverage. But over time, as the business is successful and grows, more people will follow that business. The company will be better known, also more appreciated by the public and by the stock market. And maybe at the end of the journey, it goes to an index, maybe a small cap index or a large cap index. And so ETFs and passive investments are going to get interested. So even all the household names we know today, well, most of them started very small and grew. So the idea of the small cap life cycle is to participate in that as a company that starts small, gets more known, gets into indices, and just gets more appreciated. That's the life cycle answer to your question, what a small cap is. The other one is on the pure business side. Now, we don't usually start at the small cap stage. Maybe worth pointing out, our style at Mawer is be boring, make money. And so to be boring, a company has to be established. It can't be really at the very beginning. So ideally, it has a strong position already, the business, once we start investing in it. There is a proven product or a service. Ideally, it's in some niche where it's well protected. And it has the opportunity to just grow that niche or grow out of that niche or take the business to other adjacent markets in terms of their products, in terms of service offerings, or in terms of the regions where they operate. And I'll give you an example of that now for the business and for the small cap life cycle, which I think is might give a bit more color here. It's Gentrack, a business out of New Zealand that we bought 2015. And what they do is billing software for utilities on one hand. So when you get your electrical bill, well, someone has to do that software that puts together that bill. It's quite important for the customer, actually, for the utility, because if the bills don't get sent out, well, you can't pay for that. And then they have also software for airport operations, so all the software you need to make an airport run. And when we first bought that business maybe 3 years ago, it was a small market cap, maybe a couple of $100 million New Zealand dollars. It had little analyst coverage, but it was increasing their internationalization. And they did that through a sensible strategy for staying in their language backyard. They put more emphasis on Australia and the United Kingdom, did some M&A, and all of a sudden, more people following it, and the company's in the NZ50 index, so the index of the 50 largest companies in New Zealand. So that's, I think, a good example of how the small cap life cycle can work and how the business cycle works. So it wasn't a startup when we bought it. They had been around for decades.
A couple of elements I just want to round back into in your answer there. So one could maybe conclude that it sounds like it's just a popularity contest in terms of, well, there's a small cap business and more people start following it and the price gets bid up and it enters an index. Like this is a pretty clear example of how the life cycle can happen. It's not just a popularity contest, right?
Good point. Yeah. The business will not get into an index or not grow if it doesn't have a competitive advantage and if it doesn't do good things for customers. So this is where our work really comes in. Otherwise, we could systematically, on autopilot, just buy all small businesses and hope they grow. But as active managers, our job is to go out there, look at these companies, interview management teams, read the annual reports, do the whole due diligence, and then find out which businesses have the potential today, although not maybe fully visible to someone who just looks at it on the surface, which businesses have the potential to grow into a larger organization one day, which company has the intangibles today to become a large company down the road. And then, there is that element, you're right, of other people down the road appreciating it maybe a bit more, but that is more the result of good research in the first place and of the company doing good things for customers. So it's a side effect which we're happy to take as well, but it's not the main goal of the exercise.
You mentioned kind of keys to success that you're looking for. So let's dive deeper into some of the things you watch for in terms of informing your investment decision. What types of factors do you evaluate?
Yeah, these keys to success that you mentioned, these basically come back to our investment criteria, what we look for in businesses that we buy for our clients. And so the three criteria is it needs to be a wealth-creating business run by an excellent management team, and we try to purchase these at a discount to intrinsic value. Let me quickly just jump into those 3 points. So wealth-creating business is a business that generates a return on capital above the cost of capital. Only then really wealth is created for shareholders. And then secondly, we need an excellent management team that's aligned with shareholders, acts in the best interest of shareholders and takes the business forward. In the case of small caps, takes it to the next level. And then obviously we try to not overpay for these prices, because if it was a great business with a great management team, but the price is too high, well, then the future performance will suffer. So we need a discount to intrinsic value. So these are mainly the three criteria that, you could call the key ingredients to success of a small cap company, but it also happens to be the three investment criteria we have here at Mawer for all our funds.
Okay, can we go back to Gentrack and just cover why Gentrack ticked all those boxes?
Well, there's a recurring nature in the sense that once the utilities or the airports have installed that software, they don't want to switch the next year. So there is some pricing power that Gentrack can exercise. And then software always has had the beauty, if you think of Microsoft now, really not a small cap,
right?
And hasn't been a small cap in a long time, but you write the code once and then you can resell it to many people. So there's a huge cost advantage in getting new customers on your per unit cost. So that is a wealth creating business, also because your customers are sticky and because scale plays a role.
And management teams. Gentrack's management team.
We've been very impressed by the people who brought it public. I shouldn't say the founders, but the people who ran it pre the IPO and the people who run it now. Yeah, they have a track record of acting in the best interest of shareholders, in allocating capital in a good way. Good, what we would call strategic logic. So the thinking about what they're doing, where they're expanding. As I mentioned before, this expansion into the UK, Australia, these seem reasonable steps to us. And then finally, discount to intrinsic value. When we bought it, it was at quite an attractive valuation in our opinion.
I'll say thanks for the detail on Gentrack. If listeners want to hear a little more detail on kind of that same checklist with other companies, I direct them to episode 7 with Christian. There's 3 or 4 other companies that you can listen to Christian talk through in there. So let's switch gears a little bit, Christian, a little bit bigger picture. And let's talk about kind of how the small cap market has developed in the past few years, maybe the past 10 years. It's monetary easing and has had a big impact. So let's talk through, maybe as a portfolio manager, what are some of the structural things that have changed in the small cap market?
Yeah, we've had a few structural changes, I would say. In the past, it was that a small innovative company would go to the stock market to raise more capital to expand growth. And, well, maybe because of the credit cycle, this has changed a bit. So many small innovative companies today don't go public anymore. They're incubated in a private environment, then go to venture capital. And then once venture capital has gotten them big enough, they're directly sold to private equity. So totally bypassing public markets. That's a shift. I don't know if it's better or worse, but it's certainly a shift. And often the companies that come to the market today, when we look at their balance sheet, well, it's just weak. There's lots of debt. Numbers have been what we would say optimized. And if you will, everything is stretched, financials, accounting, the balance sheet. Maybe also these companies have done price increases over and over and sort of, increased prices, but not necessarily increased the value proposition to their customers. So also stretched things there. And so these are things obviously that are not of interest or of little interest to us. But that's a bit how we feel the market has changed. And to be clear, a business like that with stretched financials, stretched balance sheet that doesn't create enough value for its customers, that's not the thing we're interested in. So I'm talking about the market in general here. And the situation I'm describing is a bit like if you go to a restaurant and there's many things on the menu that you don't like, right? And so the challenge is we still need to find something on the menu that we like, but the stuff that's coming on the menu recently, the new arrivals, the new items are just not things we're too keen on. Often that is. There are a few exceptions, right? But that's the case. And it's not, in a way, it's a problem for us because it creates more work. We have to look at more things. But it's like if I stay in the restaurant picture, on the other hand, it's not a problem because you only need to find one meal that suits you, so you can ignore the other 29, and our universe is big. It's thousands of companies. So just because there's some added that aren't our taste, that's not a problem per se, but it's certainly one of those structural changes that you have mentioned. In summary, a 10-year bull market has just brought many less palatable items on the menu. So our motto is choose wisely in this context, and that's what we're motivated to do every day here.
On that level, choose wisely. Let's transition to geographies here. Are there any tailor-made for global small caps? So are there any aspects of any single geography that say, yeah, great place for global small caps?
Well, I'd say all places are great to look. That's why we have a global mandate, so we can look everywhere. But there's some that tend to be more fruitful than others when we look. And often the blueprint is a small country that's protected through regulation or a language barrier, and where companies could have focus and became excellent through that focus. And so this a bit goes back to small cap cycle, and they have developed that excellence in a protected market, made a competitive advantage out of that, and then applied that competitive advantage to a larger market. So they left their home market and took that business model to neighboring countries or global. Switzerland and Sweden are two, European countries that come to mind for that. One example that's, unfortunately, we have nothing in the global small cap fund for that because businesses I'll talk about now are quite large. But if you think on Swiss chocolate, just because of the features of that market in the last century, Swiss chocolate companies started competing not on price, but on quality. So, Lindt today, you might have had Toblerone. So in terms of quality, these are the higher ends, and they took that quality up to a high standard in their home country. And then when they ran out of room to grow in the home country, but they proven the formula there, then they took it global. So small countries are a good one. New Zealand is one to mention there as well, and that would bring us back to Gentrack that we mentioned before. From small New Zealand, they built strength there, and now they're trying to roll it out in the significantly larger United Kingdom.
So there are certain conditions that maybe help locally build a niche and then build up your operations and grow geographically. So maybe that brings us to a good segue into talking about what we call M&A, so mergers and acquisitions. So companies that grow through acquiring other businesses. So there's a couple in the portfolio right now that are under takeover offers. Let's just talk about those in terms of how you make decisions around that within a small cap context.
Yeah, so there's two companies in the portfolio right now that are being acquired by, or in the process of being acquired by someone else. And as I said before, that's part of the small cap cycle. We try to buy businesses when they're unknown or unloved or both, while they fulfill our fundamental investment criteria. And as these businesses then are successful over time, the market just changes their perception. And eventually a competitor or some other financial acquirer gets to notice that. And so they make a takeover offer. It's a two-edged sword, really, because financially in the short term, it's very positive. Usually these deals happen at a good premium, and we're happy to get that.
Right.
But on the other side, it means we have to look for new opportunities, turn more stones, get out there, do our work.
So you have a decision to make, I guess, is when a company is either taken over or a company you own is taking over, like making a purchase. So let's walk through kind of that process. Is what are your decision parameters? What kind of decisions do you have to make in those situations?
Yeah, so let's talk about both topics. So the first one is if a business we own buys another business. So then we obviously look at the deal because it's a capital allocation decision. So in a way, management team of the company we have invested in is taking money that, belongs to our clients, to us as shareholders, really. And so we look at whether we think that has strategic logic, whether that is a sensible thing to do. We look at their historical track record. And we've had cases where we had companies in the portfolio. After they did M&A, we thought, either more highly of management or not that highly of management anymore, depending on whether we thought that decision was in the best interest of shareholders. So that may lead to trade decisions. From experience, I would say in both directions. Like either we think, this was really out of the ordinarily good, or it was really not in the interest of shareholders. So in one case, we might buy more. In the other case, we might sell a bit or sell the whole position if it's really bad. And then second part of your question, if we are on the other end of it, if a company we own gets acquired, we have a choice of whether we sell the shares right away at that moment. Usually it trades at a discount to the purchase price there, depending on what the market thinks, how likely the transaction is to go through, what the expected time to completion is. Maybe something better might happen, or what the risk is that the deal falls through. And depending on how large that spread is, we may or may not take it. We had an example this summer where one of our holdings was taken over, and the regulator in that industry, the antitrust authority, had blocked M&A deals before. And when we looked at that transaction, we thought that in the end, there would be a risk that this transaction just wouldn't go through and the stock might lose a lot of the premium it had gotten through the takeover offer. So that is one where we didn't wait until the last day. So it's really, this is also where our job as active investors comes in. We look at the parameters of every single transaction. What are the risks that the buyer can or cannot finance it? What are the risks that there's material adverse change? Are there material adverse change clauses in the documents? What will the antitrust authorities say? Yeah, all these are factors to look at when making that decision, whether we hold an acquisition target until the very end or whether we sell right after the announcement.
Okay. We're long-term investors, so Christian, we usually would prefer to hold a business that we think fit our criteria for 10 years or longer. As long as it keeps hitting those criteria, we're happy to own it.
We'll quote Warren Buffett here, our favorite holding period is forever.
Okay, great. So within that, if we look at the statistics on the fund in terms of portfolio turnover, that's not reality. I mean, the last quarter you had 5 new names in and 5 names out. So let's just talk through the decision-making process.
For new ideas, really, it's driven by opportunity. We're constantly looking at things. I mentioned the number before. In 2017, we did some 580 company or management interviews. As I mentioned, that includes interviews with managements where we own the business, but you get a sense that we talk to a lot of new businesses. So we turn over many stones. When we find something underneath, then we inquire, we talk to customers, competitors, suppliers. Eventually, if we like what we find, if the first work on that object has been worth it, then we organize our thoughts in a report, examine the quality of the accounting, do the valuation brief, we do a full due diligence and report on a business. So for new ideas, really, it's driven by what's the opportunity out there. And yeah, we need to turn many stones, but as I said, that's our job as active investors. For existing companies that are in the portfolio, what's driving the weight there or whether we sell it, that's the matrix process, as we call it. And what is the matrix? You have to think of it as 2 dimensions. On one dimension, we rank the quality, and on the other dimension, we rank the return potential of a business, of a security. And that here at Mawer is really our key tool for portfolio construction. So we constantly compare the quality and the valuation of our investments. And if things become either too expensive or our assessment of the quality of a business, of the quality of management goes down, we might trim or sell the position altogether. Just
to connect the stones analogy, we're turning over stones constantly on the new opportunities, but we're also evaluating the existing portfolio and comparing maybe against those unturned stones that we've done due diligence on.
We're comparing it against the turnstones, sort of the things we have looked at and where we have an opinion, but that we don't own already. Yeah, so we're constantly comparing what's in the portfolio. In a way, the way we think of the global small cap portfolio, it's a platform on which small companies from around the world compete for capital. And we try to make that competition as hard for these companies as possible. Right. So we only allocate to those where we really think the quality, valuation combination makes sense for our clients.
Okay, let's hit those examples. Maybe that'll pound it home.
But just a few recent examples. One was Dorma Kaba out of Switzerland. I think that's a good example. First of all, on the business, they're the global number 2 door lock access control company. So if you think of either the key you need to unlock a door, or if you think of the card to get into an office. So there's an element of recurring there, because once you have the lock, well, you might need a new key or you might need a new card if you lose it. So we like that replacement demand. There's engaged owners. There's actually 2 families that own large chunks of the business. And then I think this one is also a good example of how our process works at Mawer. So we first met the CEO 2 years ago in Switzerland at a conference. And then at the time, we didn't think the valuation was right. And then things changed in the market and their stock price came back. There were a few issues. And so, we kept track of it all the way, and we liked what they do. And so, now we thought, it now deserves a place on the matrix in terms of combination of quality, which hasn't changed that much, but valuation has changed. So now deserves a place in the portfolio, we find.
So Dorma is a good example of something we bought. Sounds like patiently. What's an example of something exiting the portfolio and the reasons behind it?
Yeah, from the recent past, maybe Origin Enterprise is a good example. That is a business that mainly does agricultural distribution in the UK and in some Eastern European countries, and now also other parts of the world. That has just moved on the matrix. So, again, the comparison of quality and valuation. And we had several changes here that we followed. And one main one really was outside management's control. That's Brexit. And so when we looked at the situation here several months ago, we thought, these negotiations are tough and the odds are not great that there's going to be a good deal, particularly for the agricultural business in the UK. Farmers in the UK depend on relatively cheap labor from Eastern European countries, so that might get cut off. Also, selling from the UK into Europe might be more difficult. Well, in 5 months' time. And finally, farmers in the UK get subsidies, partly also from the European Union. So there's a bit of uncertainty there. So when we look at the risks of this business, we thought that, this has a worse risk ranking now. And so it moved on the matrix to a point where it just didn't deserve a place in the portfolio anymore. Or to say it differently, we had another stone that we thought looked a lot better in terms of valuation and quality. So we put that in there and sold out of our Origin position.
Great. Those are 2 good examples, Christian. We've had a good discussion of process, the matrix, some good examples. Volatility has picked up in the markets lately. I just want you to give us a sense of how do you manage in a volatile time?
Yeah, the process really isn't different in volatile times. So it's important as investors to stick to our process. And so the matrix is the main tool here. I mentioned that we have the 2 dimensions of quality and of return potential. And when stock prices are volatile, the return axis, how attractive a stock is, that can change very fast. So what we see what we've actually seen not just in the last weeks, but in our opinion over the last maybe 6 months, is more dispersion between single stocks. And so that allows us to replot things on the matrix, look where they stand now, where do they stand in terms of return potential. And then if something looks more attractive, we can add to that. And if something looks less attractive, maybe because it's gone up a lot, then we can take out. So it's really the same 2 dimensions that we always do, but there is more, I would say, a bit more activity, at least in terms of looking at things and thinking about them, than in actual trading. So we look a lot at valuations these days and at price changes and ask ourselves where we can allocate capital for our clients to get a better return potential.
Okay. Thanks for giving us a really good overview of global small cap. We will have you on again, I'm sure. With that, thank you for listening, and thanks to Christian.
Thank you.
Hey everyone, Cam here again. To subscribe to the Art of Boring podcast, go to Mawer, that's mawer.com/podcast. If you enjoyed this episode, leave a review on iTunes, which will help more people discover the Be Boring, Make Money philosophy. Again, thanks for listening.